Well, good morning and welcome to the Reserve Bank. With me I've got Grant Spencer, who I'm sure you all know. He's the Deputy Governor and Head of Financial Stability. New Zealand's financial system continues to perform well, but it faces increased risks from the deterioration in the outlook for global financial stability and from developments in the dairy and housing sector. Global economic growth has softened over the past 6 months, and financial market uncertainty has increased. Globally, interest rates are at historically low levels, and this is encouraging higher leverage and leading to a build-up in risk in international asset markets. This creates risks for the New Zealand banking system, which relies on the global markets for some of its funding. The dairy sector faces a second consecutive season of weak cash flow due to low international dairy prices. Prices have recovered since August, despite the last 2 auctions, but many indebted farms are coming under increased pressure. This pressure will increase if low dairy prices are sustained or dairy farm prices fall significantly. House prices in Auckland have increased strongly, and house price to income ratios in the region are now at levels seen in some of the world's most expensive cities. Rising investor activity has been an important driver of price developments. A sharp downturn could challenge financial stability, given the large exposure of the banking system to the Auckland housing market. While it's too early to judge the effect of recent policy changes, they are expected to help moderate pressure on Auckland house prices and improve the resilience of bank balance sheets to a housing downturn.
Currently, the banks do hold strong capital and liquidity buffers and have maintained their profitability with further reductions in cost-to-income ratios. Lending growth has picked up and is being funded mainly through higher domestic deposits. The banks are working with those dairy farmers experiencing difficulty, and it's important that they continue to take a medium-term view when assessing farm viability. Losses on dairy exposures are expected to be manageable, but banks need to ensure that they set aside realistic provisions to meet likely increases in problem loans. The new rules in Auckland on Auckland residential investor mortgages came into force on 1 November. The bulk of these loans are now required to have LVRs of no more than 70%. Banks are also now required to put all residential investment loans in a separate asset class and hold more capital against these loans. LVR restrictions have been eased outside of Auckland, where housing market activity has been more subdued. However, the bank is closely monitoring the recent rises in house price inflation in some areas such as Hamilton and Tauranga. The Reserve Bank has a number of other regulatory initiatives in train. Public consultation has recently closed on a stock take of banking regulations, and the summary of submissions will be published shortly. We've recently released a consultation paper on changes to the outsourcing policy for banks, and we're also well advanced on an improved oversight regime for payment and settlement systems.
You know, the housing situation in Auckland is really one of supply. I mean, low interest rates are certainly a factor contributing to household demand, as is high migration, but in essence the solution is greater housing supply. Yeah, if you look at dairy debt, it's roughly, until the beginning of this year, it was around about $35 billion. And the interesting thing was, well, there were two interesting things. One was its rate of growth since 2003, when it had almost trebled, but also the distribution of that debt. 20% of the dairy farmers accounted for half of that dairy debt, so it was a very, very skewed distribution. We think dairy debt has increased by about $3 billion over the past 12 months, and that about half the dairy farmers are experiencing a second consecutive season of negative cash flow. So, in essence, we're very pleased to see how the banking system has supported dairy farmers in terms of working capital. We think Fonterra's interest-free loans have also helped out considerably. The difficult scenario would be if dairy prices, and particularly whole milk powder prices, if they turn down again, and as you know, whole milk powder prices hit just under $1,600 a tonne in May. They're now around $24.50, but that's still well down from the peak in February last year of $5,000 a metric tonne. So if you got a situation where dairy prices didn't recover strongly, and you had a sequence of seasons of negative cash flow, and you started to see that affect farm prices as well, land prices, then that would be a difficult scenario. There's no question about that. But having said that, the banks have been very supportive. The expectation of the experts that we talk to suggests that whole milk powder prices will move to some equilibrium level of around $3,200 to $3,800 a metric tonne in the medium term, and so that's a situation that would be very helpful.